The world is carrying more debt now than at any point in history, not because people decided to borrow more for luxury, but because modern life, industry, and government run on credit. Total global debt has climbed into the hundreds of trillions of dollars. The Institute of International Finance put the figure at about $337.7 trillion at the end of Q2 2025, a record high. Debt isn't just a big number on a spreadsheet. Measured against the size of the entire global economy, total debt now equals a little over 235% of world GDP, more than twice what the planet produces in a year. That ratio matters because it shows how much output must be used simply to service existing obligations rather than to expand schools, hospitals, factories, or research. Interest on that debt is not a trivial cost. Recent estimates put annual global interest outlays at around $10 trillion, which is roughly on the order of 8 to 10% of world output, depending on how you measure it. That is income paid from borrowers to creditors every year. Money that could otherwise fund investment, wages, or public services. Why has debt grown so large? There are three broad forces. First, the expansion of modern states and welfare systems pushed governments to borrow more for infrastructure, social programs, and security. Second, industrial capitalism and later globalization created enormous demand for credit. Businesses borrowed to build factories, ships, and networks. Consumers borrowed to buy homes, educations, and durable goods. Third, policy choices since the 1980s, deregulation, low interest rate regimes, and more recently, massive central bank bond buying have made borrowing cheaper and easier, encouraging governments, firms, and households to take on more leverage. That combination has created a system with two dangerous features. One is interconnectedness. Banks, pension funds, insurers, and sovereign wealth pools around the world own pieces of the same loans and bonds, so losses in one place can ripple everywhere. The other is rollover risk. Much debt must be refinanced periodically. If interest rates rise or markets freeze, borrowers who were fine at low rates suddenly face crippling payments. This isn't an abstract technical problem. For many emerging economies, interest and principal payments are now crowding out health and education spending. A record number of developing countries spend more than 10% of government revenues just on interest. And for households in advanced economies, higher rates can mean mortgage shocks and lower living standards. Understanding this debt mountain, where it came from, who owns it, and what happens when rates and growth move is not an exercise in alarmism. It's the foundation for sensible policy and plain survival. Over the next half hour, we'll trace the 5,000-year story of money and debt, show how past choices created today's vulnerabilities, and explain the realistic options for a world that suddenly must pay the bill. To understand why debt shapes every modern economy, we have to go back to the very beginning, to the first cities, the first written records, and the first attempts humans made to organize large societies. One of the great surprises of economic history is this: debt is older than money, and accounting is older than coins. Some of the oldest clay tablets ever discovered are not poems, laws, or stories. They are IOUs. Around 3000 BCE, in the river valleys of Mesopotamia, the world's earliest urban civilizations emerged: Sumer, Akkad, and later Babylon. These societies farmed collectively, stored grain in central temples and palaces, and managed complex irrigation systems. With this complexity came the need for record-keeping. Temple administrators developed standardized clay tablets to track taxes, harvests, wages, and loans of grain. These were the first documented debts in human history. Here's how it worked. Farmers borrowed measured amounts of grain from temple granaries before planting season. After harvest, they repaid the loan with interest, usually around 20 to 33% depending on the crop. This wasn't predatory. It was a practical solution for bridging the gap between planting and harvest. The stability of early cities rested on this predictable credit cycle. Without it, farmers couldn't grow enough to feed a growing population. But early leaders also understood something modern policymakers sometimes forget. When debt grows too fast, societies become unstable. Droughts, wars, or poor harvests could trap entire families in unpayable cycles of debt. In response, Mesopotamian rulers periodically issued debt jubilees, mass cancellations of personal debts, especially those involving small farmers. These weren't acts of charity, they were economic resets, designed to prevent social collapse and maintain a stable workforce. A striking feature of early finance is that it was deeply embedded in society and morality. Debt wasn't just an economic transaction, it had social implications. If you fell behind, you could be forced into debt servitude. This is why clean slate decrees were essential. Kings knew their power depended on balancing the interests of elites with the basic survival of ordinary people. Moving west to ancient Egypt, debt played a smaller role, largely because the state controlled most land and resources. Instead of market-based credit, the pharaoh's bureaucracy redistributed grain and labor through a tightly managed administrative system. However, records from the New Kingdom show farmers borrowing grain or tools with repayment tied to the harvest, a pattern familiar across the ancient world. In ancient Greece, especially in Athens, debt became a flashpoint for political reform. Small farmers often pledged their land and even their personal freedom as collateral. When too many Athenians fell into bondage, the statesman Solon enacted sweeping reforms around 594 BCE, canceling debts and banning debt slavery for citizens. His famous Sysaxthia, or shaking off of burdens, reset Athens' economy and laid the foundation for its later democratic institutions. Again, we see the same pattern. When debt outpaces economic capacity, societies either reform or fracture. The Roman economy brought a different financial sophistication. Rome issued standardized coins, built large-scale public works, and developed complex taxation systems. Wealthy elites lent money at interest, and debt contracts were legally enforceable. Unlike earlier cultures, Rome didn't use formal debt jubilees. Instead, bankruptcy laws and periodic political interventions softened the harshest outcomes. But Roman history is filled with conflicts between creditors and popular movements demanding relief. Several political crises, including the plebeian secessions, were triggered by debt pressure on ordinary citizens. Rome also introduced something new: large-scale public debt used to finance wars and infrastructure. Although the Republic did not maintain a permanent national debt, it frequently borrowed during military campaigns. Later, under the Empire, taxation became the primary revenue source, but private credit markets thrived. Merchants financed trade across the Mediterranean, and banking families emerged in major cities. Across all these civilizations, a consistent theme appears. Debt is not an invention of modern capitalism. It is a fundamental tool of human organization. It enables specialization, long-term planning, and collective growth, but it also creates vulnerabilities when mismanaged. Ancient rulers intuited what economists now formalize. Debt expands output when aligned with productive capacity, but becomes destabilizing when allowed to spiral beyond what society can handle. By the time the ancient world transitioned into the medieval era, humanity had already learned and repeatedly forgotten the dangers of excessive leverage. And the same dynamics that shaped Sumer, Athens, and Rome would shape later civilizations as they developed more advanced financial systems. The next evolution in the story happens in the marketplaces of medieval Europe and the trading routes of the Islamic world, where money, credit, and banking became truly global for the first time.
After the fall of Rome, Europe fragmented into small kingdoms and feudal estates. Trade shrank, literacy declined, and large-scale economic coordination faded. But debt, money, and long-distance commerce never disappeared. They simply migrated to new centers of innovation. Between the 7th and 15th centuries, two parallel worlds developed the foundations of modern banking: the Islamic Golden Age across the Middle East, North Africa, and Asia, and the merchant city-states of medieval Europe. The practices they created, contracts, partnerships, checks, bookkeeping, and early government bonds, still define finance today. From the 7th century onward, the Islamic world rapidly expanded its territories and trade networks. At its height, it stretched from Spain to India, connecting some of the richest commercial hubs of the ancient world. This created a unified economic space where merchants needed reliable financial tools that worked across thousands of kilometers. The result was a remarkable series of innovations. One of the most important was the sock, the ancestor of the modern check.
A merchant in Baghdad could deposit money with a banker and receive a written order that could be redeemed in Cairo or Damascus. This dramatically reduced the dangers of carrying physical gold or silver across long, risky routes. The Islamic world also developed advanced partnership structures, such as the Mudaraba, where one partner provided capital while another provided labor and expertise. This arrangement allowed merchants to pool resources for large trading expeditions, spreading risk across multiple investors, a concept that resembles modern venture capital. Perhaps the biggest legacy of this era was its sophisticated record-keeping. Islamic scholars and administrators refined accounting, contract law, and legal frameworks for commercial disputes. Courts recognized commercial partnerships, debt contracts, and inheritance rights, making long-distance trade more secure. These tools spread along the Silk Road into Africa, Central Asia, and Europe. For several centuries, the Islamic world functioned as the financial and intellectual bridge between ancient economies and the medieval West. While the Islamic world was flourishing, Europe was slowly reinventing its own economic systems. By the 11th century, trade fairs emerged in places like Champagne, France. Here, merchants from Italy, Germany, and the Low Countries bought and sold textiles, metals, and agricultural goods. To facilitate this trade, European merchants adopted and adapted many Middle Eastern financial concepts. The real transformation came from Italy. Between the 12th and 15th centuries, city-states like Florence, Genoa, and Venice became financial superpowers. Their economies were built on trade, ships carrying spices, wool, silk, metals, and luxury goods across the Mediterranean and beyond. But large-scale trade required capital, credit, and sophisticated financial systems. This is where Italy took a decisive leap forward. Florentine and Venetian merchants needed a way to track their debts and assets across multiple branches in different cities. This led to the creation of the double-entry bookkeeping system, first documented by Italian mathematician Luca Pacioli in 1494. Every transaction was recorded twice, as a debit and a credit, allowing merchants to monitor profit, loss, and cash flow with unprecedented clarity. The entire modern accounting profession is built on this foundation. Italian bankers also developed bills of exchange, documents that allowed merchants to convert currencies and settle debts without moving coins. A trader in Florence could draw a bill payable in London or Bruges, reducing both currency risk and transport risk. These bills became so trusted that they circulated like modern banknotes amongst merchants. Families like the Medici became Europe's first true banking dynasties. They created international branch networks, managed papal finances, issued loans to monarchs, and facilitated trade across Europe. Their operations resembled modern multinational financial institutions. Another crucial innovation emerged in Venice and Genoa: government bonds. To finance wars and naval defense, city-states borrowed from wealthy citizens and paid interest. These early bonds, precursors to today's sovereign debt markets, allowed governments to access large pools of capital beyond taxation. For the first time, a government's creditworthiness became an economic force. The financial tools developed during this period, checks, partnerships, deposit banking, bills of exchange, double-entry accounting, and public bonds, formed the backbone of modern global finance. More importantly, they solved the same challenges we face today: how to move money safely across borders, how to pool risk among investors, how to record financial transactions accurately, how governments fund large-scale projects, how creditors and debtors maintain trust over long distances. By the end of the medieval era, Europe and the Islamic world together had created a financial architecture that would soon support the rise of global empires, central banks, and industrial capitalism. By the late medieval era, the tools of finance were already sophisticated. Merchants used credit to move goods across continents, governments issued bonds to fund wars, and banking families held enormous influence.
But the next stage in the evolution of global finance required something new. Institutions powerful enough to stabilize entire nations. This is where central banking begins, not as a modern economic science, but as a practical solution to the oldest political problem on Earth: how to pay for war. As European empires expanded from the 15th century onward, their financial requirements exploded. Building fleets, maintaining armies, securing trade routes, and administering colonies required more capital than medieval revenue systems could provide. Traditional methods, taxes, plunder, or short-term borrowing from wealthy merchants were no longer enough. Empires needed permanent, reliable access to large pools of money. This pressure set the stage for the rise of central banks. The world's first true central bank was established in 1668, Sveriges Riksbank in Sweden. It evolved from an earlier institution that issued paper money backed by copper deposits. Sweden's government needed a stable way to manage currency and finance military campaigns. The Riksbank became the prototype of a public bank, an institution owned by the state, authorized to issue notes, and responsible for stabilizing the financial system. Although innovative, Sweden's early experiments with paper money showed a key lesson. Money only works if people trust the issuer. That lesson would shape the next, much more influential institution. In 1694, England faced a crisis. It needed funds to rebuild its navy and fight France, but the government was nearly bankrupt. Traditional lenders refused to provide more credit. A group of private merchants offered a solution. They would lend the government money in exchange for being allowed to form a new corporation with special privileges. This arrangement created the Bank of England, an institution unlike anything before it. It served two revolutionary purposes. It managed government debt in a structured, transparent way. Investors could buy government bonds backed by the Bank of England's credibility. It issued banknotes that circulated widely as reliable money. These notes were backed by government debt, not just precious metals. This model, a partnership between the state and the central financial institution, proved extraordinarily effective. It allowed England to raise unprecedented sums for war, infrastructure, and trade, eventually giving it a huge geopolitical advantage. Over time, the Bank of England became the template for central banks worldwide. The ability to issue government bonds fundamentally changed how states financed themselves. Instead of raising taxes sharply during a war, governments could borrow from citizens and institutions, promising future repayment. This shifted the burden of conflict from immediate taxation to long-term public obligations. By the 18th century, Britain's national debt had grown enormously, but the country was not bankrupt. Instead, the debt became a stable, tradable asset that formed the backbone of its financial system. Other nations quickly followed. The Netherlands, France, and later the newly formed United States established similar systems. Public debt transformed the relationship between governments and financial markets. A state's creditworthiness became just as important as its military strength. As central banks matured, they introduced another innovation: standardized banknotes backed by the credibility of the state. This made trade easier, replaced the inefficiencies of metal coins, and allowed economies to expand more rapidly. However, the power to create money came with risks. Governments that issued too much paper currency without restraint triggered inflation and economic instability, a problem that recurred in several countries, including France during the Revolution. The challenge became clear. Central banks needed independence, discipline, and clear mandates if they were going to sustain trust in the financial system. By the 19th century, central banks had become a cornerstone of global finance. They provided a safe, predictable currency.
By the 19th century, central banks had become a cornerstone of global finance. They provided a safe, predictable currency, a lender of last resort during bank failures, a market for government bonds, and a mechanism to manage interest rates and liquidity. These developments changed the global economic landscape. For the first time, nations had structured systems to stabilize their financial markets, manage debt responsibly, and support economic expansion. This stability, imperfect but transformative, fueled the Industrial Revolution and enabled the rise of global trade and investment. With central banks in place, the modern era of finance had been born. But it was the next period, the Industrial Revolution, that would push credit, banking, and public debt to an entirely new scale. The machines, railways, and factories of the 19th century required levels of capital that dwarfed anything before. And to meet that demand, the world would build financial systems capable of both incredible innovation and catastrophic collapse. The Industrial Revolution transformed every aspect of human society: how we lived, worked, traveled, consumed, and produced. But behind steam engines, textile mills, and railways was something far less visible, yet far more powerful: credit. The Industrial Revolution was not only a technological transformation, it was a financial one. Modern capitalism, as we know it, was born not just from innovation, but from an unprecedented expansion in borrowing and investment. Before the 18th century, most economies operated on small-scale farming, local trade, and artisan production. Economic activity was limited by what individuals could physically build or buy with their savings. But industrial machinery, spinning frames, steam engines, ironworks required massive upfront investment. No individual craftsman or small merchant could afford these costs. Factories needed large buildings, expensive equipment, steady supplies of coal and raw materials, large pools of workers, transportation networks for distribution. This scale of production created a new problem. Where would the enormous capital come from? The answer was the same tool ancient farmers had used: debt, but on a scale never seen before. Private banks, many of them family-owned partnerships, began to finance factories, canals, and turnpikes. Instead of simply holding deposits, these banks became investment hubs, channeling savings into industrial ventures. In England, banks like Barclays, Lloyds, and Rothschild expanded rapidly alongside industrial growth. They issued long-term loans, underwrote government bonds, financed mining, steel, and railway projects, and facilitated international trade. The Industrial Revolution required not only capital, but organized, long-term, large-scale credit markets, and banks rose to meet that need. The next major innovation was the joint stock company, a structure where ownership was divided into shares that could be bought and sold by investors. This form made large-scale financing much easier because hundreds or thousands of shareholders could pool money. Risk was spread across investors. Shares could be traded in stock exchanges. Companies gained permanent access to capital. The London Stock Exchange, formalized in 1801, became a central marketplace for industrial financing. Investors could now support railways, mines, and factories without being directly involved in operations. This created a profound shift. Economic power moved from wealthy families to institutional capital markets. Nothing demonstrates the financial revolution of this era better than railways. Building even a single rail line required land acquisition, iron rails and locomotives, thousands of workers, years of planning and construction. The cost was enormous. For example, in Britain, railway investment in the mid-1800s exceeded the entire GDP of some smaller European countries. These mega projects were funded through public bonds, private loans, stock issuance, and international financing. Railways were the 19th century equivalent of the modern tech boom and the first large-scale global investment bubble. With larger credit markets came larger crises. The Industrial Revolution produced some of the first modern financial collapses: the Panic of 1825,
triggered by speculative lending in South American investments. The crisis of 1847, tied to railway overinvestment. The Panic of 1873, a global economic depression lasting over 2 decades in parts of Europe and America. These crises revealed a new reality. When debt is tied to large-scale production, financial shocks spread faster and wider. Unlike medieval panics that hit single towns or regions, industrial crises affected entire national economies and sometimes the whole world. Economists began to observe a pattern. Economies moved through repeated cycles of expansion and contraction. These cycles were driven by overinvestment during boom years, rising debt levels, falling profitability, and sharp contractions when loans couldn't be repaid. The Industrial Revolution didn't just create wealth, it created volatility, and governments increasingly realized they needed institutions strong enough to manage that volatility. By the late 19th century, governments began to intervene more directly in economic affairs, regulating banks, setting interest rate policies, standardizing currencies, and building national infrastructure. The financial system was becoming too important and too interconnected to leave entirely to private markets. Everything we recognize in modern finance took shape during this era. Global trade networks, international capital flows, public debt markets, corporate bonds and shares, central bank influence, economic cycles tied to credit. The world discovered that credit is the fuel of industrial growth, but also the source of financial instability. This dual nature of debt would shape the turbulent 20th century, from world wars to depressions and eventually the creation of the global financial system we live with today.
By the start of the 20th century, credit and capital markets had reshaped the global economy. But one force still anchored the financial world: gold. For centuries, nations linked their currencies to fixed quantities of precious metal. This system created stability, but it also imposed strict limits on how governments could respond to crises. The 20th century would dismantle that link, replacing centuries of hard money with a new, more flexible, and far more fragile global system. By the late 1800s, most major economies operated on the classical gold standard. Every paper banknote could be exchanged for a fixed amount of gold. This arrangement had 2 major benefits: stable exchange rates, vital for global trade and investment, and limited inflation. Governments could not print more money than their gold reserves allowed. Under this system, Britain, France, Germany, and the United States grew into industrial superpowers. International commerce surged. Capital flowed across borders with unprecedented ease. But the gold standard had a fatal weakness: it could not handle shocks. In 1914, Europe plunged into a war of unimaginable scale. Governments needed to pay for armies, weapons, and logistics on a level never before seen. They suspended gold convertibility almost immediately. Instead of relying on limited gold reserves, they printed money and issued war bonds. The result was huge budget deficits, surging inflation, the breakdown of the once stable global monetary system. The war proved a historic truth: nations under extreme pressure always abandon gold. After the war, some countries tried to return to the gold standard. Britain restored it at its pre-war exchange rate, a decision that made its exports uncompetitive and contributed to economic stagnation. Germany, crushed under war reparations, experienced the infamous hyperinflation of 1923, when prices doubled in hours and a loaf of bread cost billions of marks. These failures made one lesson clear: the old system could not support modern political and economic realities. Then came the greatest economic catastrophe of the 20th century: the Great Depression. When banks failed and credit evaporated in the early 1930s, governments needed the ability to expand money supply and stimulate demand. But the gold standard prevented them from doing so. One by one, nations abandoned gold again. Britain left in 1931. The United States followed in 1933. France and others held on longer, suffering deeper economic pain. The Depression shifted global thinking. Economists began to argue that governments should play an active role in stabilizing the economy, managing demand, directing investment, and smoothing economic cycles. Central banks became more powerful. As World War II was ending, world leaders met at Bretton Woods, New Hampshire, to design a new global financial system capable of preventing another Great Depression. The result was a hybrid system. Currencies were pegged to the US dollar. The US dollar was convertible to gold at $35 per ounce. The IMF and World Bank were created to stabilize economies and support reconstruction. Under Bretton Woods, global trade expanded massively. Europe and Japan rebuilt. The United States became the anchor of the international system. But like the gold standard before it, Bretton Woods had limits. By the 1960s, the United States was running large deficits to pay for the Vietnam War, expanding social programs, and military commitments worldwide. Other countries accumulated huge amounts of US dollars, more than the US had to gold to redeem. Confidence in convertibility began to crack. On August 15, 1971, U.S. President Richard Nixon suspended dollar-to-gold convertibility. This effectively ended the Bretton Woods system. For the first time in modern history, major currencies were not tied to gold or any physical commodity. They floated freely in global markets, and their value depended entirely on monetary policy, interest rates, market expectations, and government credibility. This was the birth of the fiat money era. The shift brought enormous flexibility. Governments could expand money supply during crises. Central banks could manage interest rates to influence growth. And financial markets grew rapidly as credit became more abundant. But flexibility came with new risks: higher potential for inflation, asset bubbles, rapid credit expansion, currency volatility, growing dependence on central bank decisions. In the decades that followed, the world experienced oil shocks, stagflation, deregulation, and a new global financial architecture that tied nations together more tightly than ever before. The gold standard era had ended, but the age of debt was only beginning. The collapse of the gold standard and the rise of fiat currencies in the 1970s created a new financial landscape. Money was flexible, global trade was expanding rapidly, and governments had more tools than ever to influence economic growth. But by the 1980s, another powerful shift began, one that fundamentally changed the nature of modern capitalism. It was called financialization, and its effects would reshape everything from housing markets to corporate behavior to global inequality. The 1970s were marked by something economists had long considered impossible: high inflation and high unemployment at the same time. This stagflation challenged the old economic models and forced central banks to rethink their strategies. In 1979, U.S. Federal Reserve Chairman Paul Volcker launched a historic campaign to crush inflation by raising interest rates dramatically, at one point exceeding 20%. It worked, but at a cost: deep recession, business failures, and high unemployment. Yet this painful reset created the foundation for the next era. Once inflation fell and rates eventually lowered, credit could grow again, but now under a new set of political and economic ideas. In the 1980s, governments in the United States, the United Kingdom, and several other major economies began to dismantle rules that had been in place since the Great Depression. The goal was simple: let markets operate with fewer restrictions.
This shift included removing caps on interest rates, loosening regulations on banks and investment firms, allowing financial institutions to merge across sectors, and expanding global capital mobility. In the U.S., the Reagan administration championed financial liberalization. In the UK, Prime Minister Margaret Thatcher's policies, culminating in the Big Bang deregulation of London's financial markets in 1986, transformed the City of London into a global financial powerhouse. The consequences were immediate and far-reaching. Banks expanded aggressively. New financial products multiplied. Money moved across borders faster than ever before. Global capital markets exploded in size. Finance was no longer a support system for the economy. It was becoming the economy itself. By the 1990s, financial institutions were innovating at a pace that regulators struggled to understand, let alone control. Derivatives, options, futures, and swaps became essential tools for managing risk, but also for speculation. Some of the most influential innovations included mortgage-backed securities, or MBS, collateralized debt obligations, or CDOs, interest rate swaps, and credit default swaps, or CDS. These products allowed financial firms to slice, package, and trade risk in ways that had never been possible before. Used responsibly, they smoothed out volatility. Used recklessly, they amplified it. At the same time, computers and global communication systems allowed trading to become faster and more automated. Wall Street jobs shifted from traditional banking toward complex analytics, quant models, and arbitrage strategies. Corporate debt becomes a strategic tool. With low inflation and expanding credit markets, corporations found it easier than ever to borrow. Debt shifted from being a necessity to being a strategy. Companies borrowed to expand. Companies borrowed to acquire competitors. Companies borrowed to buy back their own shares. Share buybacks, once rare, became a dominant market force by the early 2000s. This boosted stock prices and executive compensation, but often added little to long-term productivity. A subtle but profound transformation was happening. Capital markets began rewarding financial maneuvers more than real economic output. For ordinary people, deregulation meant easier access to credit cards, auto loans, student loans, and home mortgages. Home ownership became a centerpiece of national policy in the U.S. Banks, encouraged by deregulation and securitization, began offering increasingly risky loans, including adjustable-rate mortgages and low documentation loans. Debt became normalized as part of everyday life. For many families, it was the only way to keep up with rising costs of housing, education, and healthcare. By the 1990s and 2000s, global capital markets were deeply interconnected. Money flowed from Japan and China into U.S. Treasury bonds. European banks invested heavily in American mortgages. Emerging markets borrowed in foreign currencies. Multinational firms moved profits through global tax structures. A crisis in one market could rapidly spread to others, as seen in the Latin American debt crisis in 1980s, the Mexican peso crisis in 1994, the Asian financial crisis in 1997, and the Russian default in 1998. Each crisis revealed the same pattern. The world was increasingly leveraged, increasingly interconnected, and increasingly vulnerable. By the early 2000s, the combination of deregulation, global capital flows, easy credit, complex financial products, rising household debt, and intense profit pressure created a fragile system. When interest rates were low, everything looked stable. But when they rose, or when asset prices stopped climbing, the full weight of global leverage was revealed. The next crisis would be unlike any before it, and in 2007, the first cracks in the system began to appear. By the mid-2000s, the global economy appeared stronger than ever. Stock markets were rising, unemployment was low, and credit was widely available. But beneath the surface, the financial system had accumulated layers of hidden risk. Years of deregulation, complex financial engineering, and unprecedented borrowing had created a system that functioned only as long as asset prices, especially housing, kept going up. When they didn't, everything unraveled. In the early 2000s, interest rates in the United States were kept low to support the recovery from the dot-com crash. Low rates made borrowing extremely cheap, and millions of households rushed to buy homes. Banks, eager to profit from new loans, began relaxing lending standards. This created a feedback loop. More credit, more home buyers. More buyers, higher home prices. Higher prices, more people speculating. Rising prices assumes mortgages are safe. Lenders offered loans to people with limited income or unstable credit. These became known as subprime mortgages. Some loans required almost no documentation. Others had low introductory rates that later reset to much higher payments. To the average homebuyer, the system seemed safe. To Wall Street, it seemed like a gold mine. Traditionally, banks held mortgages on their own balance sheets. But in the 1990s and 2000s, Wall Street introduced a process called securitization. This meant banks issued thousands of mortgages. These mortgages were bundled together into financial products. These products, mortgage-backed securities, or MBS, were sold to investors worldwide. The idea was that pooling loans reduced risk. A few defaults were fine as long as most borrowers paid. Credit rating agencies often classified these securities as very safe, even when they contained risky loans. But the next innovation made things even more dangerous. Investors wanted higher returns, so banks created collateralized debt obligations, or CDOs, bundles of mortgage securities repackaged into new layers of risk. At the same time, financial institutions traded credit default swaps, or essentially insurance policies against loan defaults. This meant banks no longer cared if borrowers were risky. They could sell the loans. Investors thought they were protected by insurance. Rating agencies gave overly optimistic ratings. The entire world became exposed to U.S. housing debt. By 2007, the system had become enormous. The value of derivatives linked to mortgages was many times larger than the actual mortgages themselves. Home prices eventually peaked. When adjustable rate mortgages reset to higher payments, many borrowers could not afford them. Defaults rose sharply. The first to fall were mortgage lenders, then hedge funds tied to mortgage securities. Soon, banks realized that the assets they held, which had previously been rated as safe, were actually deeply risky. No one knew who held toxic assets or how large the losses would be. Trust evaporated. In September 2008, the investment bank Lehman Brothers filed for bankruptcy. It was the largest collapse in modern financial history. Lehman was deeply intertwined with global markets. It borrowed heavily, traded complex derivatives, and relied on short-term funding. Its failure triggered panic worldwide. Stock markets plunged. Banks stopped lending to each other. Money market funds froze. Credit markets seized up. Without credit, businesses couldn't borrow to pay workers. Trade slowed, economies contracted. Because mortgage securities were sold globally, the crisis spread rapidly. European banks held huge quantities of U.S. mortgage debt. Emerging markets saw capital flee. Home markets in several countries collapsed. Japan and Canada cushioned the blow, but still felt the shock. For the first time since the Great Depression, the global financial system stood at the edge of total failure.
Around the world, governments and central banks intervened on an unprecedented scale. The U.S. Federal Reserve cut interest rates to near zero, provided emergency loans to banks, guaranteed money market funds, purchased massive quantities of bonds and mortgage securities. The U.S. government launched the TARP bailout program, injected capital into major banks, took control of Fannie Mae and Freddie Mac. Other central banks, the Bank of England, European Central Bank, and Bank of Japan, followed with their own rescue programs. The immediate collapse was prevented, but at a price. Governments acquired large debts to fund bailouts. Central banks became active players in bond and mortgage markets. Interest rates stayed at historically low levels for years. Too big to fail banks became even larger. A decade of cheap credit began. The world avoided depression, but the seeds of future problems were planted. Debt burdens soared. Corporate leverage increased. Housing became unaffordable in many regions. And the financial system became even more dependent on low interest rates, setting the stage for the crises to come. The world avoided a second Great Depression in 2008, but the cost was a dramatic transformation of global finance. The rescue measures that stabilized economies, near-zero interest rates, massive bond buying programs, and trillions in government spending created a new financial environment unlike anything seen before. The decade that followed became known as the Age of Zero Interest Rates, a period defined by cheap money, rising asset prices, and a global economy increasingly dependent on credit. After the financial crisis, central banks in the United States, Europe, Japan, and the United Kingdom slashed interest rates to almost nothing. In some countries, rates even went below zero. Policymakers believed low rates would encourage businesses to borrow and invest, support job creation, stabilize housing markets, and prevent deflation. And in many ways it worked. The global economy slowly recovered, stock markets rebounded, unemployment fell, but the long-term consequences of these policies would reshape the entire structure of modern capitalism. Alongside low interest rates, central banks deployed a powerful new tool, quantitative easing. This wasn't traditional money printing. Instead, central banks created electronic money to buy financial assets, mostly government bonds and, in the US, mortgage-backed securities. This accomplished several things at once. Bond yields fell, making borrowing cheaper. Asset prices rose, from stocks to real estate. Banks received liquidity, reducing the risk of collapse. Governments financed spending at low cost. Between 2008 and 2019, central bank balance sheets expanded from around $5 trillion to more than $20 trillion globally. The world entered territory it had never seen before. With interest rates so low, corporations found borrowing incredibly attractive. But instead of investing primarily in factories or research, many firms used debt to buy back their own shares. Share buybacks boosted stock prices, which increased executive compensation and attracted investors. Over time, this shifted the purpose of corporate borrowing. Less funding for long-term productivity. More funding for financial engineering. Higher leverage across major corporations. Debt became a dominant feature of corporate America, Europe, and parts of Asia. Even healthy companies borrowed because it was cheap, and because not borrowing meant falling behind competitors using leverage to inflate returns. One of the most profound consequences of the zero-rate era was the survival of zombie companies, firms that earned too little to cover even the interest on their debt but stayed alive because borrowing was cheap. These companies tied up labor and capital, reduced overall productivity, survived only because cheap credit kept them afloat. By the late 2010s, some studies estimated that 10 to 20% of all publicly listed companies in advanced economies had characteristics of zombies. This was a sign of an economy where failure was being artificially prevented. Cheap borrowing didn't just affect corporations, it reshaped housing markets around the world. Low mortgage rates made home loans more affordable, pushing demand higher. In many countries, housing prices outpaced wages. Investors purchased homes as financial assets. Urban areas saw rapid price inflation. Younger generations struggled to enter the market. Cities like Vancouver, Sydney, London, New York, and Hong Kong saw dramatic increases in housing costs, a trend still visible today. Between 2009 and 2020, stock markets experienced one of the longest bull runs in history. But much of this growth was driven not by productivity or innovation, but by low interest rates, QE liquidity, corporate share buybacks, asset inflation. By the late 2010s, stocks, bonds, and real estate were all near record highs simultaneously, something rarely seen before. This raised an uncomfortable question. Had financial markets become too dependent on cheap money? Governments also took advantage of near-zero rates. Instead of cutting deficits after 2008, many countries maintained or increased borrowing to fund infrastructure, social programs, tax cuts, and crisis responses. For advanced economies, debt was affordable. For emerging markets, global investors sought yield in higher-risk markets, fueling their borrowing too. The world's total debt across governments, corporations, and households surged to new heights long before the pandemic hit. Throughout the 2010s, the global economy grew, but cracks were visible. Productivity growth slowed. Inequality widened. Asset prices soared while wages stagnated. The financial system relied on low rates to stay stable. Debt loads were rising across every sector. Economists debated whether this stability was genuine or merely the result of constant intervention. But few expected what would come next, a global shock that would test the entire system built since 2008. In early 2020, that shock arrived.
In early 2020, the world faced an economic shock unlike anything seen in modern history. Unlike the financial crises of 2008 or the recessions of the 1970s, the COVID-19 pandemic wasn't triggered by failing banks, rising inflation, or collapsing asset prices. It was a global shutdown of economic activity itself. Millions of businesses closed by government order, supply chains halted, and entire industries frozen overnight. For the first time, the world deliberately stopped large parts of its economy to protect public health. That decision forced the greatest intervention in financial markets and monetary policy ever recorded. By March 2020, borders closed, flights were grounded, and consumers stayed home. Within weeks, global trade collapsed, oil demand plunged, tourism evaporated, factories shut, small businesses lost all revenue. The speed of the downturn was staggering. In the United States, over 20 million jobs disappeared in a single month, far faster than during the Great Depression. Across Europe and Asia, similar patterns emerged. Traditional recessions unfold gradually. This one happened all at once. It wasn't caused by too much debt or a financial imbalance, but it threatened to expose every weakness built up over decades of borrowing. Faced with the risk of a global depression, central banks responded with unprecedented speed and magnitude. Within weeks, they cut interest rates, launched emergency lending programs, and began expanding quantitative easing far beyond post-2008 levels. The U.S. Federal Reserve, the European Central Bank, the Bank of Japan, and the Bank of England collectively injected trillions of dollars into the financial system. The scale was unparalleled. The Fed expanded its balance sheet by more than $3 trillion in months, eventually reaching over $8 trillion. The ECB launched its Pandemic Emergency Purchase Program, buying government and corporate bonds at record speed. The Bank of Japan continued its long-running policy of aggressive monetary expansion. Emerging market central banks, many for the first time ever, used quantitative easing strategies to stabilize their own markets. This wasn't just liquidity support, it was a lifeline. Without these interventions, credit markets might have frozen, businesses might have collapsed en masse, and unemployment could have spiraled far beyond 2020 levels. Monetary policy wasn't enough. Governments enacted emergency fiscal interventions on a scale never seen before. In the United States, multiple stimulus bills injected trillions directly into households and firms. Europe launched furlough schemes paying wages for workers who stayed home. Japan, Canada, and Australia created business support programs and direct payments. Many emerging economies provided subsidies, food support, and emergency loans to keep people afloat. The goal wasn't to stimulate demand, it was to prevent collapse. The pandemic created a paradox. People earned money without working, and businesses survived without revenue. This happened because governments replaced lost income with direct payments. Central banks kept borrowing costs near zero.
Financial markets were strongly supported by QE. For many households, savings actually increased in 2020 because spending opportunities were limited. But this masked an underlying fragility that would emerge later. One of the most surprising outcomes was a rapid surge in asset prices. Stock markets recovered quickly and hit record highs. Real estate markets boomed. Crypto assets exploded in popularity. Technology firms experienced massive valuation increases. Why? Because the vast amount of liquidity created by central banks flowed into financial markets. With interest rates near zero, investors sought returns in riskier assets. Instead of a depression, the world saw one of the largest asset booms in history, even while millions of businesses remained shut. As economies reopened in late 2020 and 2021, pent-up demand collided with broken supply chains. Factories struggled to ramp up production. Ports were clogged, and shipping costs soared. This led to shortages of electronics, automobiles, and raw materials, surging commodity prices, rapid inflation across most advanced economies. By 2022, inflation reached levels not seen in 40 years in the US and Europe. Central banks faced a new challenge: how to fight inflation without crashing heavily indebted economies. To control inflation, central banks raised interest rates dramatically beginning in 2022. This brought an abrupt end to the decade of cheap money. Borrowing costs doubled or tripled for households, corporations, and governments. The world entered a dangerous phase: enormous debt burdens meeting sharply higher interest rates. The pandemic had prevented collapse, but it had also magnified every existing financial vulnerability. The next stage of global finance would be shaped not by stimulus or crisis response, but by the slow tightening of monetary policy across a heavily leveraged world.
When inflation surged in 2021 and 2022, central banks faced the most difficult policy dilemma in decades. For nearly 15 years, the world had relied on low interest rates to keep economies stable, asset prices high, and borrowing cheap. But now, after trillions in stimulus and supply chain breakdowns, inflation was rising at the fastest pace since the early 1980s. Central banks had a choice: either let inflation run, which would erode savings and destabilize economies, or raise interest rates sharply, risking a recession in a world drowning in debt. They chose the latter. Beginning in early 2022, the U.S. Federal Reserve, Bank of England, European Central Bank, and many others launched the fastest series of rate hikes in modern history. Within months, U.S. rates jumped from near zero to over 5%. Europe exited negative rates for the first time in years. Global borrowing costs surged for households and firms. Mortgage rates doubled or tripled in many countries. The era of cheap money that had defined global finance since 2008 came to a sudden stop. For many, it felt like the ground had shifted beneath them. Inflation was driven by a combination of forces: pandemic supply chain disruptions, surging energy prices, labor shortages, strong consumer demand powered by stimulus savings, geopolitical shocks, especially the war in Ukraine, years of asset inflation finally spilling into consumer prices. Unlike previous cycles, this inflation wasn't only about monetary policy. It reflected real shortages and cost pressures across the global economy. But central banks had only one tool: raise interest rates to cool demand. Higher interest rates didn't just affect new borrowers, they hit existing debt as well. Global debt, which had soared to record levels during the pandemic, now had to be refinanced at much higher rates. This is the refinancing wall, a massive volume of bonds, loans, and mortgages maturing between 2023 and 2026. When they rolled over, governments faced higher interest bills. Corporations risked insolvency. Households saw mortgage payments skyrocket. Financial markets absorbed huge amounts of new issuance. For many borrowers, the math simply stopped working.
Debt that was manageable at 2 to 3% interest became unsustainable at 7 to 10%. Millions of families felt the impact immediately. Adjustable rate mortgages reset to higher payments. Rent prices surged in many cities. Car loans and credit cards became more expensive. Food and energy inflation reduced disposable income. In some countries, homebuyers who took mortgages during the 2020-2021 boom saw their monthly payments double. Younger generations faced an even more difficult landscape, with housing affordability at record lows relative to incomes. Many corporations had borrowed heavily during the zero-rate era, but once rates rose, the weakest firms, often called zombie companies, face existential threats. These are businesses that can only survive when debt is cheap because they lack the earnings to cover interest expenses. As refinancing costs rose, bankruptcies increased in sectors like retail, shipping, and manufacturing. High-yield or junk bond markets came under pressure. Venture capital funding tightened. Tech companies conducted mass layoffs, and commercial real estate values plunged in some regions. The decade-long safety net of cheap credit had vanished. Governments also suffered. Many advanced economies entered the 2020s with record levels of public debt. Higher rates meant larger portions of national budgets going to interest payments, less room for public services, infrastructure, and healthcare, tougher choices about taxation and spending. In some developing countries, higher interest rates triggered full-blown sovereign debt crises, forcing restructurings and IMF interventions. While banks in the US and Europe were better capitalized than in 2008, the rapid rise in rates created new vulnerabilities. Some banks held large portfolios of long-term government bonds purchased when rates were low. As rates rose, the value of those bonds fell dramatically. This contributed to the collapse of several institutions, most notably in 2023, and prompted regulators to take emergency measures to stabilize confidence. By 2023 and 2024, the world experienced slowing growth, weak investment, stagnant productivity, declining manufacturing output, tightening credit conditions, fragile financial markets. Inflation fell, but at the cost of economic momentum. Many analysts warned of a higher-for-longer interest rate era, a stark contrast to the previous decade. The years 2022-2025 mark a turning point in global finance. The world transitioned from cheap money to expensive money, expanding credit to shrinking credit, asset inflation to asset repricing, easy refinancing to refinancing risk, debt-fueled growth to debt-constrained growth. This shift didn't cause a sudden collapse, but it created a new environment where every financial decision carries more weight and where high debt levels make the global economy far more sensitive to shocks. The stage was now set for the most important question of all. What does a world with $330 trillion of debt mean for the future?
By the mid-2020s, the world reached a historic milestone. Not a milestone of progress, but of obligation. Global debt across governments, corporations, and households climbed to well over $330 trillion, the highest total ever recorded. Debt had grown faster than population, faster than productivity, and faster than global output. In simple terms, the world owes far more than it produces in an entire year, by a margin of more than 2 to 1. To understand why this matters, we need to break down what this debt actually is, who owns it, and why the current structure makes the global economy unusually vulnerable. Global debt is usually divided into 3 main categories. Government debt, around $100 trillion. Governments issue bonds to pay for public services, infrastructure, defense, healthcare, and social programs. In many countries, government debt surged during the 2008 crisis and then exploded again during the pandemic. Low interest rates made borrowing seem almost free, encouraging leaders to postpone difficult fiscal decisions. Corporate debt, around $100 trillion. Companies borrowed to expand operations, build factories, invest in technology, or acquire competitors. But over the past decade, corporate borrowing increasingly financed share buybacks, dividends, and acquisitions, activities that boosted stock prices but did not necessarily improve long-term productivity.
Corporate debt levels now sit near all-time highs in both advanced and developing economies. Household debt, around $115 trillion. This includes mortgages, credit cards, car loans, and student loans. Housing booms in North America, Europe, and Asia pushed mortgage balances to record levels. Rising cost of living, particularly healthcare and education in some countries, forced families to rely more heavily on credit. Household debt is now a major economic pressure point because interest rate increases directly impact monthly payments. These three pillars together form the global debt mountain, a structure that grows larger with every economic cycle. There are several structural reasons debt expands more quickly than economic output. Low interest rates made borrowing extremely cheap for over a decade. Aging populations increased government spending on healthcare and pensions. Weak productivity growth reduced the ability of economies to grow fast enough to outgrow debt burdens. Global competition kept wages stagnant, pushing households to borrow for housing and education. Financialization made debt a central tool for corporations seeking to boost shareholder returns. Government incentives, such as mortgage subsidies, encouraged borrowing. Crises such as 2008 and 2020 triggered massive borrowing to stabilize economies. Debt was not only tolerated, it was encouraged, and as long as interest rates stayed near zero, it seemed manageable. But that era is over. As interest rates rose sharply between 2022 and 2024, the cost of servicing global debt increased dramatically. Estimates suggest that more than $10 trillion per year now goes toward interest payments across governments, corporations, and households. This creates several critical problems. Governments must divert tax revenue toward interest instead of infrastructure, education, or social programs. Corporations have less cash for investment, research, or hiring. Households spend more on mortgages and credit cards and less on consumption, slowing economic growth. In other words, servicing old debt reduces the ability to invest in the future. High debt levels create fragility in three major ways. 1. Sensitivity to interest rates. When global debt is this high, even small rate increases can cause corporate bankruptcies, housing market declines, fiscal crises in indebted countries, and reduced consumer spending. The global economy becomes extremely sensitive to monetary policy. 2. Contagion risk. Modern finance is deeply interconnected. Banks, pension funds, insurers, and sovereign wealth funds all hold large amounts of debt. When one part of the system breaks, as seen in 2008 or in several regional banking crises in 2023, the effects can quickly spread across borders. 3. Limited policy options. High debt constrains government decisions. In the past, governments could cut interest rates, borrow more, or spend heavily to fight recessions. Today, interest rates can't be cut too quickly without risking inflation. Government borrowing is already high. QE becomes politically and economically difficult. The toolkit is limited. Many developing countries face a more immediate threat. They often borrow in foreign currencies, particularly US dollars. When interest rates rise or their currencies weaken, their debt burdens explode. Dozens of countries now spend more on interest than on healthcare or education, creating long-term development problems. The combination of rising interest costs, slowing economic growth, high levels of existing debt, geopolitical instability, tightening financial conditions, and weak productivity creates an environment where the global financial system is unusually fragile, not necessarily on the brink of collapse, but operating with very little margin for error. The next part of the documentary will explore why this fragility matters, and more importantly, what a world this indebted is heading toward. With global debt at historic highs, interest rates elevated, and economy slowing, the world is entering a period of profound uncertainty. Economists disagree on what happens next, not because the data is unclear, but because the outcomes depend on a delicate balance of policy decisions, market reactions, and geopolitical stability. The global economy is now like a heavily leveraged machine that can still run but has lost much of its braking power. Small shocks can trigger outsized consequences. Broadly, three scenarios dominate expert discussions: a soft landing, long-term stagnation, or a deeper crisis triggered by cascading defaults. All remain possible. None are guaranteed. A soft landing is the most optimistic outcome. It means inflation continues falling without triggering a severe recession. For this to happen, central banks slowly lower interest rates. Economies adjust to higher borrowing costs. Governments manage fiscal deficits responsibly. Corporate refinancing stress doesn't spiral into defaults. Geopolitical disruptions remain limited. Some economies, notably the United States during 2023 to 2024, displayed pockets of resilience. Labor markets remained strong, consumers kept spending, and inflation gradually eased. But even in the best-case scenario, the world faces slower growth than before. Debt service costs remain high. Government budgets stay constrained. Companies reduce investment. Consumers remain cautious. A soft landing doesn't solve the debt problem. It simply stabilizes it. Global debt would continue growing but at a manageable pace, assuming no major shocks. The second possibility is what many economists call secular stagnation, or, more simply, long-term economic stagnation. Japan experienced this after its asset bubble burst in the early 1990s. The country avoided a depression but spent decades with very low growth, very low inflation, near zero interest rates, high public debt, a stagnant property market, aging demographics. Today, many advanced economies show similar characteristics: aging populations in Europe, China, and parts of Asia, slow productivity growth across the developed world, weak business investment, high government debt limiting fiscal policy, housing markets structurally unaffordable, rising inequality reducing consumption demand. In this scenario, governments would struggle to stimulate growth without pushing debt even higher. Central banks, constrained by inflation fears, would have limited tools. Economies wouldn't crash, but they also wouldn't accelerate. This future is stable, but uncomfortably slow. Financial markets stay fragile. Younger generations face lower economic mobility. Debt remains manageable, but never fully addressed. The third scenario is the most severe. It doesn't require a dramatic collapse, just a few key failures that ripple outward. A global debt crisis could begin in several ways. A major emerging market defaults on sovereign debt. A large corporation collapses unexpectedly. Commercial real estate losses spread through bank balance sheets. Central banks raise or hold rates higher for longer due to persistent inflation. A geopolitical shock, war, sanctions, energy disruption destabilizes markets. Because global finance is deeply interconnected, a single failure could cause bond market volatility, yields spike as investors demand higher returns, bank losses, especially in institutions holding long-term bonds or risky loans, credit tightening, banks restrict lending, slowing growth further, corporate defaults, especially among firms facing refinancing at higher rates, housing market corrections, reducing household wealth and spending, government crises, particularly in nations with high debt to GDP ratios. This is not speculation. The world has witnessed versions of this before. Latin American debt crisis, 1980s. Mexico, 1994. Asia, 1997. Russia, 1998. Eurozone debt crisis, 2010 to 2012. The difference today is scale. Global debt is far higher and economies are more intertwined. A severe recession could emerge not from one catastrophic event, but from many small failures.
Experts disagree. Some believe central banks have enough tools to prevent a global collapse. Others argue that debt levels are simply too high to sustain without future crises. But there is broad consensus on one point. The world economy is more fragile than at any point in the last 50 years. Key vulnerabilities include public finances strained by aging populations, corporations carrying high leverage after a decade of cheap debt, households with large mortgages vulnerable to rate spikes, banks exposed to real estate and government bond losses, governments divided politically, reducing their ability to respond quickly, geopolitical tensions increasing the likelihood of shocks. The global system is not on the edge of immediate collapse, but it has very little margin for error. The next phase of global finance will be shaped by how quickly interest rates fall or don't, whether inflation resurges, how governments handle ballooning deficits, whether productivity can revive growth, the resilience of financial institutions during refinancing waves, the stability of geopolitically sensitive regions. The future may not be catastrophic, but it will certainly be challenging. The world built on cheap credit must now navigate the consequences of expensive credit. What comes next depends on decisions made in the coming years and on the ability of economies to adapt.
It's a question people ask whenever global debt becomes overwhelming. What if all the world's debt just vanished? What if humanity started fresh? It sounds like liberation. No mortgages, no credit cards, no government deficits, no corporate borrowing. A world finally unburdened. But the truth is more complicated. A world without debt is not a world running smoothly. It is a world forced to rebuild the entire structure of modern finance from scratch. To understand why, we need to break down how deeply debt is woven into the system. In today's economy, debt is not simply something you owe. Debt creates money. When banks issue loans, they create new deposits. When governments issue bonds, they create the safest assets in the global system. When corporations borrow, they finance long-term growth. When households borrow, they enable homeownership and education. Roughly 90% of all modern money exists because someone, somewhere, borrowed it. Eliminate all debt instantly, and you would also eliminate most of the world's money supply. Let's imagine the world wakes up tomorrow and every form of debt has been wiped clean. Number 1. Governments become debt-free, but pension systems collapse. Government debt isn't just something governments owe. It is something people own. Pension funds, retirement accounts, insurance companies, banks' safest reserves, central bank collateral, sovereign wealth funds. If government bonds vanished, retirement savings would evaporate instantly, insurance companies would collapse, safe assets would disappear, financial markets would lose their backbone. The government might be debt-free, but the population would also lose trillions in savings. Number 2. Banks collapse immediately. Banks are simple in structure. Assets, loans. Liabilities, deposits. If all loans vanish, banks lose their assets, but still owe depositors money. That means banks go insolvent, depositors lose their savings, payments stop working, ATMs shut down, credit cards become unusable, the entire financial plumbing freezes. A debt-free world is, paradoxically, a bank-free world, and that means no functioning economy. Number 3. Corporations lose capital and go bust. Companies rely on bond markets, bank loans, credit lines, venture funding. Erase their debts and you also erase their financial relationships, their ability to fund payroll, their capacity to invest, their operating capital. Even profitable companies collapse without access to credit. Large projects, from factories to research labs to renewable energy infrastructure, would become impossible without credit. Number 4. Households celebrate briefly. At first, families would feel rich.
No mortgages, no student loans, no car payments, no credit card debt. But the celebration would be brief. Bills would still exist, jobs would not. With banks and corporations collapsing, unemployment would skyrocket. Housing markets would freeze because nobody could borrow. A home would be something only extremely wealthy buyers could purchase with cash. Number 5. Global trade crashes. International trade depends on letters of credit, trade financing, currency swaps, export credit agencies. With no debt instruments, global trade would slow dramatically. Even essential supplies like petroleum, food imports, medicine, and raw materials would stall. The world would enter a humanitarian disaster, not a golden age. If humanity chose to redesign a debt-free, interest-free system, not erase it overnight, the world could evolve toward a different kind of economy, but it would be radically unlike today's. Instead of loans, investors take ownership stakes. Businesses share profits instead of paying interest. Entrepreneurs rely on partnerships, not debt. This resembles medieval trade finance or modern venture capital, but scaled globally. Without credit, large infrastructure projects take decades. Housing development slows. Innovation funding shrinks. Technology advances more gradually. Debt-based economies accelerate progress. Without it, growth slows to the pace of accumulated savings. Debt allows people to invest in homes, businesses, and education early in life. Without it, homeownership falls, entrepreneurship drops, upward mobility slows. But the upside is a more equal distribution of wealth because financial assets grow more slowly. Without leverage, the economy is steadier. No financial crisis caused by overborrowing. No massive defaults. No speculative bubbles fueled by credit. But also, smaller financial markets, more limited global trade, lower living standards in the short term, fewer rapid technological leaps. Humans could build a sustainable equilibrium, but only after decades of restructuring.